Paying for college just got more expensive. On July 1st, interest rates on federal student loans went up. But don't panic. There are ways to ease the burden. I talked with local financial professional Mike Kojonen about what students and parents need to know before they borrow. Mike, thanks so much for joining us. As always, I'll start with our first question. How much more money will students be spending this time around?
Yeah, well, it's for this coming school year, and for the most part, the rates have gone up about 1% right across the board. It's 0.9 and change. So roughly you can count on almost a 1% increase, and that's for, undergraduate loans, graduate loans, the plus loans out there, about a 1% increase. So what does that really mean to you as the borrower, whether it's, the parent or the student? The average person is taking out about a 10-year student loan, paying it off over a 10-year period. It's going to cost you about $550 more of interest per $10,000. So when you look at, a lot of people are graduating now with $40,000 of student loan debt. That's going to cost you about another $2,200 of interest payments over that period of time.
It might not seem like a lot immediately, but it will add up, and that interest will keep going. So what should borrowers be thinking about before they take out that student loan?
Yeah, first of all, do some research. Calculate the cost of college, because obviously there's different prices of schooling. I went to community college first, and then I got my associate arts degree, then transferred to a state university. But there's a big price difference between a community college and a four-year university, state universities, and private universities. So a recent study just kind of found an average cost per credit in a community college cost per credit is $142 on average, where four-year public universities just shy of $396. It's 65% lower in tuition just to go to a community college. So, but it's not just that. There's other expenses. So if you're going to go to a four-year university, you might have to have a car, or some universities don't let you have a car. You actually have to Uber everywhere or take bus lines. But you're going to have other expenses on top of that, living expensing, food, and stuff like that. So do the research first to find out what can you afford, what kind of university is going to fit, for you.
And once you've kind of honed in on that payment, whether it be for your cost of living, your books, your food, and then of course the tuition, just maybe breaking it down into a budget of sorts, maybe by month?
Yeah, I think most people don't even think about what that cost is going to be these student loans when you get out of school. So I know the payments don't start till school is done, but a lot of people just don't have any idea what those payments are going to be. So, we don't even get a cell phone plan without knowing the cost of that monthly payment, or a car or a house, as you just closed on a house, which, people look at those prices. And so figure out what that's going to be, because I think people think when you get out of school, you're going to have so much money, you don't even think it's going to be irrelevant, but really it's not, because you're paying for your rent or and car payments and insurance and food and gas and everything. And then you find out, I don't have much to pay this student loan debt. So which kind of leads to, you got to know your repayment options, Jeff, because right now about 11% of students who just left school within a year are already in default. And we don't want that to be an issue for you. You have to know your repayment options. There's over 8 different repayment options available. Some are income-based, job-based. You can extend them out up to 25 years, these student loans. So find out what is best for you. And I always recommend, I have on my website a student loan calculator as well, so you can go and figure out, kind of play with the numbers, what those payments look like, because you want to make sure that you're going to get into a loan that's going to be doable and feasible based off what your degree is going to be and what kind of job it's going to look like.
And you mentioned already, people might have expectations about how much money they're going to be making right out of college, but this isn't something that they're just paying off those first 4 to 5 years. People need to start thinking decades ahead. Isn't that right?
Yeah, the more you can do today, do your due diligence today, the more effort and time you put in research and even your career, what you're going to be doing. I think sometimes we think the placement's 100%, and we know people struggle finding jobs and work in careers that don't even fit what they went to school for. So do your due diligence, because that could save you a lot of headaches, 10 years, 15, 20, 30 years down the line. When it comes to taking the student loans out, I recommend try not to take these student loans out for anything beyond just your tuition and books. A lot of times they're pushing to take out these living expense loans and these plus loans. And I think if you can just try to limit it just to tuition books, that'll help you.
It's the student going to school, but it's really the whole family that can get involved in all of this. So proper planning, of course, important when you're getting these college loans. Mike, thank you as always for having some time to talk to us and helping the future financially get ready.
Thanks, Jeff.
You'll find more money advice from Mike on WCCO.com.